What we're going to have a look at here is a type of investing called Forex trading, or what is known as foreign exchange, or simply abbreviated to FX. Now, it's probably the largest and most liquid market in the world. Liquid means lots of trading happening at once, lots of buyers and sellers, lots of opportunities to get in and out of positions very quickly. Now, this is a 24-hour-a-day, 5-day-a-week trading period. That's what makes it so liquid. It's always alive, lots of buyers and sellers active at once. It starts Monday morning New Zealand time and it finishes over in New York on Friday afternoon when trade closes for the play there. What that represents and why it's so liquid is a 6-day continuous trading cycle. If you wanted to trade right through the night or right through the day, you can do it. There will always be traders there. Again, that is why it's so liquid. Now, usually a trade involves two currencies, one versus the other. Now, let's have a look at a couple of them. We've got the Aussie dollar versus the US dollar, or the Aussie dollar versus the Kiwi, the New Zealand dollar. Another one, the Aussie dollar versus the Canadian dollar, or the CAD. Now, let's have a look at a trade and see how it works. $1 versus another, one currency versus another. We'll start with the Aussie dollar versus the greenback, the US dollar, and let's say 75 Aussie cents is worth $1 American dollar. What you can do is you can buy a position, and that means you want it and expect it to go up. Now, let's say it does go up and it goes up to a figure of, say, 77 cents, a couple of cents up. Now, because you've entered the position and you've bought it, what you need to now do is sell it off. So keep this in mind, and this is an example. You started at 75 cents, so you've got 75 cents in your hand. Someone comes along and says, I'll buy that 75 cents off you. Okay, for how much? 77 cents. Of course you're going to take that. Take profit. It's a good deal. It's a good trade. Or you can sell starting at 75 cents, and selling means you want it and are expecting it to go down. And let's say it does go down and it goes down to, say, 73 cents. Let's look at another situation. You've sold at 75 and it's gone down to 73. So to exit your position, you have to buy. Think of it this way. You've got 73 cents in your hand. Someone comes along and says, I'll buy that off you for 75 cents. There's profit, good deal. And that's how foreign exchange and currency conversion works against each other. It can be considered very high risk. It's very fast moving. And if you're trading without knowledge of things like foreign markets, of what's happening overseas, or currency history, what usually happens between these two currencies, you could get in trouble very quickly. So what you need to do is put in place a risk management strategy using things like stops or stop losses. And that means you put a designated figure down where if it gets down to something or goes in the wrong way, you're out at that point. Remember, preserving your capital is always number one when you're investing or trading. You could be trading with your super or your savings. Now that is gold. You've spent a lifetime earning that. It's hard-earned money and it needs to be respected. Have a look at our risk management video and get an overall understanding of how you can protect yourself using things like stop losses or getting advice and analytics from brokers or fund managers. If you are going to enter the Forex game and start trading foreign currencies, good luck and happy trading. But as for now, thanks for watching.